Hey everyone, and welcome back to the show. Today we are taking a deep dive into something that you specifically requested, and that is understanding the warning signs of a financial crisis. I know some of you might be thinking, oh, this is going to be a real downer, right? But trust me on this. Think of it this way. We're giving you the tools, right? The knowledge, so you can spot the patterns yourselves, and you can make really smart choices about your finances. To help us on this journey, we've got some really fantastic insights from financial expert Nolan Matthias. He's put together this, a really clear breakdown of how crises work. And spoiler alert, it's not all doom and gloom. I mean, this guy has worked with everyone from just, individual investors all the way up to huge hedge funds. So he definitely knows his stuff.
Yeah, he really breaks it down well, too, like right off the bat. He starts by laying out the difference between like a bubble bursting,
Yeah.
a recession,
Yeah.
and then a full-blown financial crisis. It's like sometimes these terms get thrown around like they're all the same thing, and it can be so confusing. Matthias really argues that just knowing the difference between these three things can really help us avoid, like, panicking necessarily.
Yeah, that makes total sense. I mean, we all remember the dot-com bubble bursting, right? That was definitely a rough time. But it didn't, trigger a global meltdown or anything.
Exactly. Matthias even points out that a bubble bursting like the dot-com crash, it might lead to a recession, which technically speaking is just 2 consecutive quarters of negative GDP growth. Not ideal for sure, but a true financial crisis, that's on a whole other level,
Yeah.
We're talking a systemic meltdown with widespread global consequences.
Like the 2008 housing crisis or the Great Depression, times when it felt like the whole world was just teetering on the edge. So what does Matthias say separates a crisis from a regular recession?
He points to a few key elements. First, you've got your classic asset price bubbles. It all starts with, irrational exuberance and speculation. And this drives prices way beyond any kind of reasonable level. It's like that classic example of tulip mania back in the 1600s. People were literally buying futures contracts on tulips. Imagine betting your life savings on whether the price of a flower will go up or down.
That sounds insane. I can't even imagine getting that caught up in the hype.
Right, it sounds wild, but it really highlights how powerful hype can be. And that brings us to Matthias's next point, which is debt. He argues that debt is really what turns a bubble into a full-blown crisis. When people borrow heavily to buy into the hype, the eventual collapse is that much more devastating.
Okay, I'm starting to see how this works, but why is debt so dangerous in this scenario?
Think of it this way. Imagine you buy a house for $500,000, and you put down a $100,000 deposit. You're taking out a $400,000 loan for the rest. If the housing market booms and prices go up by, let's say, 10%, you make a cool $50,000 profit.
Right.
But here's the catch. If the market crashes and prices drop by 10%, you suddenly lose $50,000. And you're still stuck with that $400,000 loan.
Ouch. That's a scary thought. So the debt basically magnifies the losses.
Yeah.
Because you still owe the same amount, even though your asset is now worth less.
Precisely. And when everyone is leveraged to the 2008 housing crisis,
Yeah.
those magnified losses, they can create a ripple effect through the entire financial system. People start defaulting on their loans, banks start collapsing, and it just quickly spirals out of control.
So it's like a domino effect, but with money in debt instead of dominoes.
Exactly. And Matthias argues that recognizing these debt-fueled buying frenzies is crucial. He uses the Roaring '20s as a prime example. Back then, margin trading was rampant, which is basically borrowing money to buy stocks. People were leveraging themselves to the max, just assuming the good times would never end.
So basically, they were throwing gasoline on an already raging fire.
You could say that. And we all know how that story ended. The 1929 stock market crash wiped out fortunes, and the Great Depression followed soon after. Matthias says these patterns have played out time and again throughout history. Overconfidence leads to easy credit, which fuels speculative buying, which inflates the bubble even further. And then, inevitably, confidence disappears.
And when that happens, everyone rushes to the exits at the same time, causing the whole thing to come crashing down.
Exactly. The lack of buyers combined with massive debt triggers a cascade of selling, and prices plummet. It's a classic recipe for a financial crisis.
So it's like Matthias is saying, history doesn't repeat itself, but it often rhymes. Well, if we can learn to recognize the tune, maybe we can avoid getting caught in the same dance. But what about today? Are there any modern examples of this playing out?
Well, Matthias brings up the recent craze around cryptocurrencies, things like Bitcoin. He's not saying stay away completely, but he warns against getting too caught up in the hype, especially if you're using borrowed money to buy in.
That makes sense. I remember when Bitcoin was like all over the news a while back and everyone seemed to be jumping on board. It felt like a gold rush mentality.
It's exactly that kind of fear of missing out, or FOMO as they call it, that Matthias cautions against. He points out that if you're going to play that high-risk, get-in-early game, you need to be prepared to get out just as quickly. Otherwise, you could be left holding the bag when the bubble bursts.
So it's like musical chairs, but with millions of dollars at stake.
Pretty much. And Matthias emphasizes that this kind of speculative frenzy isn't limited to crypto. He says you can see similar patterns in the stock market, too. He gives this example of a real estate company that was recently valued higher than Remax.
Wow, that's wild. But how can you tell if a company's valuation is justified or if it's just hype?
That's where something called the price-to-earnings ratio, or PE ratio, comes in. It's a way of measuring whether a company's stock price is kind of in line with its actual earnings. A really high PE ratio can be a red flag, suggesting that the stock is overvalued and potentially in bubble territory.
Okay, so a high PE ratio could be a sign that things are getting a little too frothy and might be time to proceed with caution. But Matthias isn't all doom and gloom, right? He does offer some advice on how to protect ourselves during turbulent times.
Absolutely. He's a big believer in using knowledge of these historical patterns to our advantage. He talks about gold as a really interesting case study. He explains that gold prices often surge after a crisis. It's a classic flight to safety move. When people are scared and uncertain, they flock to assets they perceive as stable, like gold.
So people buy gold because they think it will hold its value better than other investments during a crisis.
Exactly. But here's the thing. Matthias points out that gold prices tend to revert over time as confidence returns. So he suggests an interesting strategy. He recommends fixing a certain percentage of your portfolio for gold selling when it exceeds that percentage and buying when it dips below.
That's a pretty clever approach. It takes advantage of those predictable market swings without requiring you to be some kind of expert gold trader.
Right. It's about recognizing the pattern and having a plan. But Matthias's advice isn't limited to just gold. He has some broader strategies for weathering any financial storm.
I'm all ears.
He emphasizes two key things: diversification and avoiding debt.
Those sound familiar, but I have to admit, diversification always seems a bit overwhelming to me. I mean, how do you even know where to start?
Matthias actually recommends looking into Ray Dalio's all-weather portfolio. Dalio is this legendary investor who believes in building a portfolio that can withstand any economic conditions, kind of like building a house designed to survive any kind of weather.
Okay, I like that analogy. So it's like you need a strong foundation, sturdy walls, and a solid roof to protect you from the elements.
Exactly. Dalio's portfolio is designed to do just that. It includes a mix of stocks, bonds, and commodities, providing stability no matter what the economic weather throws your way.
So instead of trying to predict the storm, you're building a shelter that can withstand anything.
Precisely. And the other piece of the puzzle is, of course, avoiding debt.
Yeah, that seems to be a recurring theme here. But why is Matthias so adamant about avoiding debt, especially during uncertain times?
He argues that debt acts like a magnifier during a financial crisis. Remember that house example we talked about earlier? Well, it's the same principle. If you have a lot of debt, even a small drop in the value of your assets can wipe out your savings and leave you in a really precarious position.
So it's like trying to walk a tightrope while carrying a heavy backpack.
Exactly. The debt makes you much more vulnerable to any kind of economic shock.
Okay, so diversification and avoiding debt. Those are the cornerstones of weathering a financial crisis. But can we ever really predict when the next one will hit? Or are we just always waiting for the other shoe to drop?
That's the million-dollar question, isn't it? Like, if we can't predict the future, how can we truly prepare for something like a financial crisis?
Right, that's what I'm wondering.
Well, Matisse acknowledges that trying to predict the exact timing of a crisis, it's near impossible. But he argues that we don't need like a crystal ball to make smart choices. It's about recognizing those patterns and shifting our mindset from fear to like proactive preparation.
So instead of panicking about when the next crisis might hit, we should focus on building like a really solid financial foundation that can weather any storm.
Exactly. He emphasizes that just understanding how these cycles work, it really empowers us to make better decisions. For example, knowing that gold prices tend to spike after a crisis but eventually revert, that can really help you avoid like buying high and selling low.
That makes a lot of sense. It's about recognizing those emotional reactions, right? And not letting them dictate your financial decisions.
Right. Remember his suggestion about setting aside a fixed percentage of your portfolio for gold?
Yeah.
That's a really tangible way to actually capitalize on those predictable market swings. You're basically taking the emotion out of the equation and making decisions based on historical trends. not fear or greed.
So it's like instead of just riding the wave,
Mm,
you're learning how to surf it. You're anticipating the ups and downs, and you're using them to your advantage.
I love that analogy. It perfectly captures the essence of Matthias's approach. It's about being proactive, not reactive. And that proactivity extends beyond gold to your overall financial behavior. Remember those two key pieces of advice he kept emphasizing: diversification and avoiding debt.
Absolutely. But I think a lot of people struggle with actually putting those concepts into practice. Diversification can feel really overwhelming, and debt is so ingrained in our culture, you know? It feels like everywhere you turn, someone is trying to convince you to take on more debt.
That's why Matthias's advice is so critical. He's not saying that all debt is inherently bad or anything, but during a financial crisis, it can quickly turn into your worst enemy. It magnifies losses, and it can even lead to financial ruin.
So it's about being mindful of how much debt we're taking on, and really for what purpose.
Exactly. Especially when it comes to like speculative assets, things like Bitcoin or meme stocks. Those are bets, not investments. And taking on debt to fuel those bets is incredibly risky.
It's like doubling down on a hand of blackjack, when you already know the odds are stacked against you.
A perfect analogy. And when it comes to diversification, it doesn't have to be overwhelming. Remember Matthias's suggestion about Ray Dalio's all-weather portfolio? Think of it like building a house designed to withstand any kind of weather. You need a solid foundation, strong walls, and a roof that can protect you from the elements.
So Dalio's portfolio is like that well-built house. It has all these different components that work together to provide stability and resilience no matter what the economic weather throws your way.
Precisely. It's a way to build a portfolio that's not overly reliant on any single asset class or market condition.
So the key takeaway here is that knowledge is power, especially when it comes to our finances. By understanding the warning signs of a financial crisis, recognizing those historical patterns, and taking proactive steps to diversify our investments and avoid that excessive debt, we can position ourselves to weather the storm and come out stronger on the other side.
It's about taking control of your financial future and making informed decisions that align with your goals and values. Matthias really emphasizes that financial literacy. It isn't just about making money, it's about protecting what you've earned and building a secure future for yourself and those you care about.
And that brings us to a final thought for you to ponder. How can you use this newfound knowledge of financial patterns to make more informed decisions about your own finances? What steps can you take today to strengthen your financial foundation and prepare for whatever tomorrow may bring?
Keep exploring, keep learning, and remember, history is a valuable teacher, especially when it comes to our finances. Thanks for joining us on this deep dive.
See ya.